Awesome. You ready for this? The IEC coming to you live. Today we're going to talk a little bit about the markets. Never seen anything like this, more wild, halting, stopping, starting, crashing, rebounding, VW, long U, short U. We're going to hear it all. I'm so excited to have Morgan Christen, who's the partner of Joe Stapleton, one of our profound founding members of the IEC. In fact, I think, Joe, you hold the record of the most referred members. Everyone you brought in are rock stars. You guys are obviously running one of the most prolific wealth management firms in Orange County. We're so honored to be associated. You guys take good care of me and a lot of people that are associated within our community. And we're really honored to have Morgan back with us. If you recall, in the fall of 2019, my partner Kevin Maloney of IEC suggested, hey, we got to do an economic forecast. We did one in 2018. It was a great start to a series. And Morgan came in and crushed it. I mean, he put together this great PowerPoint presentation about all things around the market, real estate. It was a nice, compact economic forecast in the garage of a veteran mortgage entrepreneur, and it was a blast. We had an open bar. That's when there was no social distancing. But now we're coming to you live via Zoom to talk a little bit of a different angle, which are the markets, which is something that we wanted to focus on today's call. So just by way of background, so everyone's familiar of the acumen and domain expertise of Morgan. Morgan is the Chief Executive Officer and Chief Investment Officer of Spinnaker Investment Group, which is based in Newport Beach, California. In fact, if you ever go to the Pacific Club, it's in that beautiful, shiny black building, fantastic office space. In this role, he leads the investment committee in building customized portfolio solutions for high net worth clients. Mr. Christen brings over 27 years of investment management experience. I don't know how that's possible, Morgan. You must be like 35, so I don't know how you started that young. Morgan founded and led Signature Resources Capital Management in Irvine as the Chief Investment Officer, Portfolio Manager in charge of research and asset allocation. Prior to joining Signature, he served as the president of Charter West Consulting, a money management firm in Newport Beach. Additionally, he acted as the vice president of Dolphin Securities, a regional broker-dealer, and managed the firm's 30 representatives. He holds a Bachelor of Science in Business Finance from the University of Southern California, and my wife would be very proud, she's a Trojan, she loves it, an MBA from Pepperdine University. In addition, he holds the Chartered Financial Analyst, the CFA, Certified Financial Partner, CFP, and Certified Divorce Financial Analyst, CDFA. I don't know anyone that needs a CDFA, designations, and served as a board member of the CFA Society of Orange County. In addition to all those impressive titles, he serves on the finance committee of the Pacific Club, where you'll find him having lunch pretty much every day, as well as a board member, where I am as well, at the Grazio Dio School of Business, where IEC co-founder Kevin Maloney also earned his degree. With that long-winded introduction, I'd like to turn it over to my friend and our distinguished speaker today, Morgan Christen, to take over with his presentation. Morgan?
Awesome. Thank you, Sinan. Thank you all for joining this call. I'm going to start with just like I did in the man cave there, with a PowerPoint. So I'll go through some things as Sinan said, what happened, what was impacted, and where do we go from there. So I'm going to go ahead and just share my screen here and pop off the screen myself. So if you guys can all see that now.
Looks good.
It looks good? Perfect. So, when before I start, kind of a word on statistics, and we're getting inundated with a lot of news and a lot of things, and I always think of spurious correlations, like this. You can make anything fit, like this situation here, per capita cheese consumption, and how it perfectly coordinates and correlates with the number of people who died by becoming tangled in their bed sheets. So we're all getting hit with a lot of information, a lot of charts and all that. And I would say, as Mark Twain said, there are lies, damn lies, and statistics. So, careful reviewing and taking in all the information we're getting hit with. Now, markets, what happened? Well, I would say March, it would be March madness. There was nothing, no asset class, nothing was immune. The S&P 500, really obviously spurred by COVID, March saw some of the largest moves as Sinan just said, since the Great Depression. From March 1st through March 23rd, the S&P lost a quarter of its value. It hit a bear market, which means 20% down in record time. It only took 16 sessions. And by March 23rd, the year to date for the S&P was down 34%. During the time period of March 9th through March 18th, the market went up or down 4.8% every session. And level 1 circuit breakers were triggered 4 times. That basically means that it was halted for about 15 minutes. And then 3 times during that period, it closed down 7.6. And on March 16th, it closed down 12%. So pretty dramatic. It was absolutely March madness. Then the Fed stepped in. We're looking at the 10-year here. The Fed stepped in, acted swiftly. It was a Sunday night. They did a 75 basis point emergency move. That was on the 3rd of March. We entered March with the 10-year Treasury at 1.15% yield. And within 6 days, it hit unimaginable level of 0.31%. And just for some context there, the 30-year bond went from 1.68 to 0.7. And then what happened during that time, markets became extremely illiquid. Credit spreads blew out. Anyone in the mortgage world probably noticed that. High quality corporates as tracked by the ETF LQD, that thing fell 22%. This is a bond. Municipal bonds as tracked by MUB fell 13%, and short-term bonds fell by about 6.2%. So it's pretty dramatic even in the bond market. Then we look at West Texas crude. There was a price war going on mid-March between the Saudis and the Russians. So we saw oil, it went well below 20, and that's really the first time since 2002. And if you know anything about the oil patch, that's below the cost of production. So pretty dramatic move in oil. And then of course gold fell. All these charts are showing where they've come back to, but gold fell about 13% during that period. So, oops, why is that not going down? So obviously COVID was a huge part of what was going on there. I mean, we saw, that's really the trigger point. But what else was going on? Well, what we saw since the last recession was that there was more and more use of margin. What margin is borrowing to buy stock. So if I have a $100,000 account, I may have $50,000 on margin. The rest is my equity in there. Well, what happens is all of a sudden the market starts pulling back, and you have to start selling. We have to start coming up with some of this margin. I have to start coming up with equity here. And what do I sell? I'm going to sell my quality stuff first because it's going to give me the higher price. High quality bonds, high quality stocks, those were sold. So not that this was the only trigger, but certainly the high levels of margin exacerbated the very rapid decline in the S&P. Now, going to the economy, looking forward, I mean, we have housing starts fell off. Obviously we have a supply issue for all of you in California, all of us in California. We still have a supply issue, and that's only going to make that worse. Auto and light truck sales fell off a cliff. Retail sales clearly fell off. And then obviously this isn't even updated. The jobless claims is a lot worse. But I will say just one note that they changed the way they calculate the unemployment rate. In the past, some of these people weren't included, including those that are furloughed. So you're going to come back at some point potentially. People that left their jobs because they feared getting infected at work, or people taking care of infected family members. But also, if you have multiple jobs and you lose one of them, you can also collect. So they did change it. But I will say that, looking forward here, the numbers are going to continue to be ugly. Not only in the unemployment numbers, but your GDP numbers as well as your earnings. So that's kind of the base of where we came, what we're looking forward to. And so let's look at really who is or was or has been or will continue to be impacted? Well, obviously apparel. People can't go to the malls, they can't go shopping, so they're not buying clothing. People are working from home, so they're not worried about their outfit. So apparel was hit. Automotive. Although GM saw some light trucks purchased, most people stopped going and picking up cars. They're not repairing them. Gaming, clearly, you can't go to Vegas. That was shut down. Lodging, can't travel. You're not going on vacation. Leisure, restaurants, and of course the airlines, and all of that goes into travel and sports. On that call today that Joe did with the Pacific Club, I mean, you're looking at the new SoFi Stadium and what they're looking at doing. Does the season start most likely without fans? And so sports were obviously hit pretty hard. Newsom basically came out and said, you don't have to pay rent for 90 days after, you don't have to pay rent until 90 days after I declare this thing over. And so really, who knows when that over is. Moderate impact, you're looking at business services, things like marketing, consumer services, healthcare and pharma. Healthcare is a mixed bag, though. I was talking to someone at Kaiser earlier today, and they need 70,000 new members a year for their models. They're negative 50, so they have about 120 to make up. But some areas are doing well. A lot of pharma is doing well, and then wholesale distribution. Low impact, software services, packaging, telecom, and of course waste management. We're probably producing a lot more waste at home. Maybe not as much at restaurants, but that doesn't go away. And then the impact on consumer and government, looking at changing behaviors. So communications, it's changing right now, and I think that will change going forward. Telecommunication, we're doing this on Zoom. I've been on so far, this is my third Zoom for the day, and that's where things are going. They're highly efficient. Board meetings are very efficient. There's other programs like Hop In. So what does that impact on travel, hotels, banquet halls, real estate? Do you need a big office space? Healthcare, a lot of telehealth. So what will the hospital of the future look like? There's companies around here in Irvine that do home monitors and various things like that. So that'll change. E-commerce, clearly, we're all getting stuff from Amazon for a while, but a lot of different places. And then, of course, everyone working at home, cloud computing. That's going to be these are all changes that we're seeing now, and I think these are changes in the future. Leisure and entertainment. Boomers for the last several years have been shifting from consumption to experiences. So this is an area that's done quite well up until COVID. And so they've been looking at, boomers are looking at sports that are, or experiences that are less physically demanding, more golf and things like that. So where does that go? That's certainly feeling the pain right now, and it could for some time. Supply chains are changing potentially. There's a bipartisan support to bring things back home. I think people didn't realize how much or what percentage of drugs are made in China. So I think there's going to be some changes there. The continued, cashless society, the Venmos of the world and all of that. Takeout versus dine-in, that could be a thing of the future. I know myself and a lot of people would love to go out to a restaurant, but I think that this is going to be something in the future here, that takeout. Will that continue? I think companies are adapting to it. They're working on their delivery options. But some of these restaurants, I mean, how do you run at 50% occupancy? It's a tough deal. But I think a theme going forward, because all of us that are cooped up, acquisitions will mean less. It's going to be more and more experiences. So anyone who's in that world to provide experiences, I think will do well. But also, countries are feeling the pressure. I think they're going to feel continued pressure to spend on healthcare and welfare, and possibly away from defense. And the reason why I say that is after World War II, Churchill came out of that and they booted him and they brought in the Labor Party to focus focus on health and welfare. And so that'll have impact in the future. What does that mean in California as far as we have a decent amount of defensive companies here. So I think that those are some changing behaviors as we move forward. So where do investors go? Well, the Fed has committed to lend or buy trillions of dollars of financial assets. Some estimates are that they could be doing up in excess of 8 trillion when it's all done and said. Now, to give you some context, the 08 through 09 period, the Fed did 3 trillion. So we're looking at almost triple the amount of helicopter money that's flowing out there. And if you look at this chart, you look in the gray, that's how we started the year. We had the 3-month giving you about 1.5, and the 30-year at 2.33, and then that just dropped. We don't get above 1% until we're out 30 years. So rates are extremely low. So our belief is that rates will be low for a while. So that's bad for savers, savings accounts, CDs, even bond buyers too. And it could be very bad for insurance companies because, as you know, that they have to do duration 20, 30 years, and so they have to buy bonds to match that. So that they'll have some impact there. But I think the stock market says, like they have for years, the old axiom, don't fight the Fed. And so certainly that liquidity is held up this market a bit. And then, this is obviously, I don't think this COVID is like any of these because of the shutdown, but markets generally, well, they've seen a lot, obviously AIDS all the way up to measles there. And they've moved forward. So let's take a look at the winners and losers here. So this is the breakdown of the S&P 500. And so right now the Fed has put a massive amount of liquidity in there. And if you look at where the top sectors are and really why the S&P has moved forward, 40% is in technology and healthcare. Two sectors that have done quite well in the last, call it, month. 40% is in tech and healthcare. And, we have the FANGs and all of those that are doing well. And even all the new companies out there, Moderna, older companies like J&J, they're holding up quite well. So S&P is really being propped up by certain areas of the economy. One thing we look at when we look at in general at the markets is really a focus on dividends. The S&P 500, historically, 40% of your return has come from those dividends. So I would say for someone that wants to see, is this market move up, is it sustainable? We'll have to see some change in leadership, meaning it can't just be tech and healthcare. It can't just be large companies. We're going to have to see some small and mid-cap companies move forward. I think that before we see that and we see some of these other stocks doing well, because a lot of these sectors, energy, real estate, discretionary, industrials, those are still down 20 to 30%. But until we see some of those movement, it's tougher to say that this current market movement is sustainable. We'd also say, careful, chasing any of the COVID stocks, Costco, Clorox, Zoom, Netflix, Amazon. But, sectors that certainly look good and there's how things will change and where you should focus. When you're looking at, say, the first area there, technology, obviously companies that focus on clouds, teleconferencing. But again, I would caution running to Zoom because there's a lot of new companies out there that are doing that. E-commerce, but again, companies that offer experiences. I mean, this isn't a recommendation, but companies like Activision and stuff like that. I mean, they're giving experiences out there. Also, companies that are changing and adapting. Companies like Salesforce that are getting tools to navigate, this new world of reopening. But there's some big old, the tech companies have been around for a while. They're doing a lot of this stuff. I mean, your Microsofts and IBM and all of that. Healthcare, I think as I focus on healthcare, there's a lot of older companies that look great, but who's becoming innovative in healthcare when you're looking at teledoc, or speaking with your doctor over the phone, or remote monitoring, or biotech that is looking in areas for rare diseases, testing, and all of that. So that's certainly we think that there's still some continued strength in both of those sectors. Financials, this is an area that we would potentially nibble on, but I think you have some concern going forward if you're a bank. The CARES Act is giving some forbearance on mortgages, but depending on the bank and depending on the terms, you're going to have to start paying that back at some point. It doesn't go away. And as I said earlier, with this Newsom giving people this option not to pay rent, there's a lot of landlords that have to make some payments here. So I think that the banks are certainly something to look at. I think the homeowner is in probably better shape than they've been in the past, because they do have homeowners, because they do have some positive equity. But I don't think banks really know; they don't have a clue yet how hard they'll be hit. Communication services. Those are good, nice dividend areas. Your Verizons and all of that. That's a nice area there. Consumer discretionary, generally consumer discretionary leads out of a recession. They're one of the, because everyone rushes back. In fact, Louis Vuitton saw spikes in sales in China as they lightened up. But the question there is, will consumers sustainable? And that's, we'll see how that kind of works its way out. So industrials, this is an area we'd stay away from. We get a lot of questions. Should I be buying airlines and all of that? I think it's a tough deal, because I think the airline industry will change, and I think that the change will be maybe not just short term. I don't want to say permanent, but it's probably midterm will change. I don't think they'll be back for some time, because that's travel. I think also if defense spending slows down, even Warren Buffett sold all of his airline stock. So our basic thought there is we wouldn't be gambling in that area. And if you do, make sure you're nimble if you're going to buy it to get out of it quick. We just think it's a tough area to be in. Consumer staples look great. Utilities have some questions to them, as governments are giving breaks to some people to pay their bills. And real estate, again, everything with Gavin rents, schools, office buildings. If we're telecommuting, why do I need this big office? Strip malls. But in real estate, if it's an area you want, there are some real estate investment trusts that do cell towers and storage and distribution. And then finally, materials, chemical and steel. Those are okay. But again, right now the market is being pushed by those top areas, and we really need to see some of the other areas to start moving. So really, my final slide is, Dave Grohl, Foo Fighters. It's times like these, we learn to live again, and I think we will. I don't think you ever short America. And just like this ant line, you look at a line of ants and you stomp on it, and they scatter real quickly, and then everyone gets back in line. And so I think we will, and things will get back in line. If you're an investor, or speculator, timing's tough. Like I said, March had the fastest bear on record. It also had the largest 3-day surge since 1931. So if times like right now, I'd be adding to quality stocks if I'm buying stocks, good names, and I'd be probably selling my riskier stuff at this level. Focusing on good quality companies, strong balance sheets. Companies that pay dividends tend to be stronger companies. And sometimes you need recessions like this. This one's not the kind I like, because everything's shut down. But sometimes you need to flip the switch. It's like calling tech support. They tell you turn off the computer and flip it back on. You need to clean things up. We were concerned with the oil market before we entered all of this, because there was a lot of debt. So strong companies will emerge. A lot of technology, a lot of change will emerge, which ultimately will be better. And then finally, markets are working. Boeing went out and raised $25 billion in debt. That offering was oversubscribed for. So the markets are working there. And actually today is the 10-year anniversary of the flash crash, if you remember back 10 years ago, where the it dropped the market dropped 1,000 points in minutes, only to come back. So with that being said, I'm gonna leave my share and back to Sinan for, I guess, questions.
Awesome. Morgan, awesome. You gave us the whole world in 20 minutes. Let me start with the question, and I invite IEC members to just go in the chat box now and feel free to throw questions out. One question, I come into your office. I know you're FINRA, regulated, and there's only so much you can talk about, but where does your crystal ball see? I come in with $1 million in cash, liquidity. Where's a good place? What's a safe bet to put some of that?
Yeah, we would start off, we'd open a brokerage account, obviously, put the money in there, and probably start off with a good chunk sitting in cash, sitting in things that earn interest while we slowly move into this market. We're not, again, I showed you why you shouldn't time, but we would be slowly moving into this market, nibbling here and there, good quality companies, but it may be 6 months before that money's fully invested.
Got it. Any observations on oil too, seeing these all-time lows? I mean, it just seems like such a no-brainer buy, right? I mean, people are going to come back out with their cars, consume fuel. What are your thoughts on oil?
Yeah, the problem is we have just it's a massive amount of supply here. And so I think oil is investable. I think you get more clarity in about 6 months because we need some of these companies to go under. We'll see who takes them over. Chevron and Exxon, they're keeping their dividend where it's at, and so that's good. But some of these may need to start cutting their dividends, which will affect the stock price. I had this discussion with my son the other day, and he said, "Why don't we just buy a bunch of barrels of oil and bring them home?" But we don't think it's investable right now. You can watch for spikes. It is low, but airplanes aren't going to be flying too much right away. Yes, we'll be driving, but are we going to go back? So yeah, I don't see it coming back right away. So I wouldn't. If you own it, fine. If you want to nibble on it, fine. But I wouldn't expect a massive recovery in oil.
Awesome. Well, it looks like those are the few questions that have come in. We're right at the half hour, so we absolutely covered it all here on our IEC call. So I really appreciate your time, Morgan, and thank you for your insights. You're a great resource to so many. You've got your new Spin Cycle platform. I highly encourage everyone who's listening to this and watching this to go through, meet with Morgan, meet with Joe. They're a great resource. You guys provide so much insights to folks like us that need that sort of compass on investment, on just having that confidence in what we're doing with our resources. So I present to you Morgan Christen. Thank you very much for your time.
Thank you. Appreciate it. Thanks, Sinan.
Take care,
Thanks, guys.
All right.
Have a good day.